You know that spreading your money around lowers risk. That's diversification. But here's the question nobody answers clearly. How much of your money should actually go into stocks, how much into bonds, and how much should just sit in cash? That's called asset allocation, and it's the decision that shapes almost everything else about your returns. This is episode 5 of the finance module in the business notebook. If you're just joining, we've covered the time value of money, compound interest, risk and return, and diversification. Today, we put those pieces together into an actual portfolio. Asset allocation is simply the percentage split between asset classes, usually stocks, bonds, and cash. Each one behaves differently. Stocks grow the fastest over time, but swing hard in bad years. Bonds grow slower, but cushion the fall. Cash barely grows at all, but it's always there when you need it. The right mix depends on two things: how long you're investing for, and how much volatility you can actually stomach without panic selling. Let's make this concrete. Imagine you have 100 million dong to invest. A young investor with 30 years until retirement might go with an aggressive allocation: 80% stocks, 15% bonds, 5% cash. That's 80 million in stocks, 15 million in bonds, 5 million in cash. Someone closer to retirement, say 5 years out, would flip that around. Maybe 30% stocks, 60% bonds, 10% cash. That's 30 million in stocks, 60 million in bonds, 10 million in cash. Same total money. Completely different risk exposure. Why? Because the young investor has decades to recover from a market crash. The retiree doesn't. Here's the part most people skip. Allocation isn't a one-time decision. If stocks have a great year, your 80-15-5 portfolio might drift to 88-9-3. You're now holding more risk than you planned. Rebalancing means periodically selling a bit of what grew and buying more of what didn't to get back to your target percentages. Once a year is usually enough. The most common mistake isn't picking the wrong percentages. It's changing them out of fear. Selling all your stocks after a crash locks in the loss and misses the recovery. The allocation only works if you actually stick to it through the rough years, not just the good ones. Your asset allocation is the single biggest driver of your long-term returns, more than which specific stock or fund you pick. Next episode, we zoom into that stock and bond split itself and break down exactly what you're buying when you buy each one, because they're built completely differently. See you in episode 6.